So the game with credit spreads is kind of like when we used to play tag as kids. It's actually really fun. And what you want to do back in tag and with credit spreads is you want to be as close as you can to the person that's it without actually getting tagged. So, people say, well, if you really didn't want to get tagged, wouldn't you be across that field and across the road and way down the way? And, you can't get me. I'm a half a mile away. Well, the truth is that wouldn't be much of a game in tag. And so when you watch kids play tag, they get right up to the person that's it and they wave their arms around and they kind of antagonize them a little bit and they try and get them to chase them, which is what's going on here. Well, with credit spreads, here's how that works, is the closer you are to the underline, the more you get paid. And we just saw that when we took a look at that graph. The closer those options are to the current price of the underlying stock, the more you get paid because that's a higher probability option. But the trick here is you don't want that stock to ever touch your strike price. So the trick is to sell far enough away to not get tagged, but close enough to collect a really nice return. So this is just the basic concept of credit spreads, and this is how this is what I want you to think of. I want you to get some of these really good concepts. They'll come in really handy. So one of the things that you have to understand about options is they're actually contracts. So how do we make money by selling these options? So when somebody buys an option, they spend money, and what they buy is they have rights. So in the case of calls, they have the right to buy the stock at a certain price for a certain period of time. So in this case, they've got 2 weeks of time, and if they buy a 120 call, they can buy the stock at 120. If they buy a 122 call, they can buy it at 122. Why would anybody want to buy this option when the stock is, currently going for 118? Well, they could just go buy the stock, but that costs a lot of money. If they buy the 120 call, they might only pay $1.19 for it. And think about how valuable this 120 call would get if the stock were to suddenly shoot up to, 124, 126, whatever. So you can double or triple your money on these options when they go in a certain direction. But we're not talking about being an options buyer right now. We're talking about being an options seller. That's what we're investigating here, is why we might want to be an options seller and why that might be a good thing for us. But when you start off and you first look at it, you think, well, gosh, the option buyer has rights. So what does the option seller have? The option seller has obligations. And we get paid, and this is the really good news, is we get paid for taking on those obligations. So we get paid for obligating to sell a stock at a certain price in the case of selling calls, and we get paid for buying the stock at a certain price in the case of selling puts. So here's an example. If we sell a put at the 116 strike and we get paid $1.18 for that. By the way, that's $1.18 per share. And options are traded in 100 share contracts, so it's really easy to figure out what you're going to get. You just move this decimal point 2 points to the right. So on this one contract we would get $118 for. 10 contracts we'd get over $1,100 for. So the money can add up pretty quick based on your number of contracts. So we're obligating to do that, but think about what could happen here. If this stock totally falls out of bed and goes straight down, and we told somebody, in fact, we didn't just tell them, we obligated with a contract that we would be willing to buy the stock, and we have to buy the stock for 116 if they make us do that, and the stock is all the way down at 110. Well, in order to buy it at 116, we have to go out on the open market and do that. So that could get very, very expensive. But I want you to understand this concept. Options are contracts. When we sell an option, we are creating a contract for ourselves that is good for the amount of time that option is enforced. In this case, it's 2 weeks, or until we close out the trade, buy back what we sell, and finish our obligation or complete our obligation. So there's some big advantage to selling options as opposed to buying them. And so why would we do that? Why would we obligate ourselves? Well, the reason that we would do that is, number one, we get paid, and number two is we have a very good chance of winning. So let's just take a look at a basic scenario here with a stock. So we're looking at this, and we do our technical analysis, and we do our chart reading and everything else, and we think, well, we know which way this stock's going to go. Well, I don't know if you've traded for any length of time at all, but here's an amazing thing, is sometimes the stock doesn't do what we think it's going to do. Kind of crazy how that works out sometimes. In fact, it can work out that way so many times that you get a little frustrated. But one thing I can tell you is there's only 5 things that a stock can do. A stock can just take off to the upside. It can really take off like a rocket and really go higher. It can go up a little bit. A stock can also go up and down, but at the end of the day, at the end of the 2 weeks, it can basically go sideways. The stock, this one looks like it's rolling over perhaps a little bit. It can also go down a little bit. And then, of course, a stock can also just absolutely crash, and it can go down a lot. Well, here's what's interesting about this. Out of these 5 scenarios that a stock can possibly do, we are going to make money by selling this put strike down here. We're going to make money on 4 out of the 5 scenarios. And we can only lose money on 1 of them. And you know what? Stocks tend to go up, they tend to go down, they tend to bounce around. A lot of the time they're going sideways. It isn't very often they take off in one direction and just sustain that move and keep going that way relentlessly. It happens. I understand that. It happens all the time. Sometimes stocks really trend, but most of the time in most scenarios we're going to win here. And so what we're trying to do is we're trying to create, and this is just, if you ever think about getting into the markets and actually supporting yourself with the money that you're going to make, we want to create a mathematical expectation of winning. We want to stack the deck so far in our favor. We know, hey, even if we lost a trade on our trade today, chances are good that if we put on another one, we're going to win on the next one, because most of the time we win. And in this scenario, you can see that you do.
Peter says to see the complete presentation on how to create more stock market income every month than dividend stocks typically pay in 3 years, go to www.stockmarketpaychecks.com or click on the link in the comment section below.